All right, welcome everybody to the October Tampa Cashflow Meetup. And today we are going to talk about how you can invest for cash flow. And we wanted to have a little bit of a spooky theme since Halloween is right around the corner, albeit it's probably going to be a different type of Halloween this year than, previous years, but we're going to make the most of it. So the agenda we have today is we're going to introduce ourselves. Who are the tech guys who invest? Who are Adam and Kevin? Then we'll talk about what it means to invest for cash flow. What is cash flow, first of all, at the highest level? Then Adam and I will talk about respective investor identities, talking about cash flow through mortgages and multifamily. And then lastly, we'll wrap everything up with actions for success, things you can do today to get the ball rolling, because without action, there is no success.
All right. Thanks, Kevin. Most of you know me, Adam Yulry. I'm an agile business coach for my day job. And when I'm not doing that, I'm investing in multifamily. I'm a syndicator of large multifamily apartment deals. And I describe myself as a servant leader, which means I love to help other people and really serve them in a way that helps them grow.
Awesome. Well, I have a 9 to 5 also in tech. I am a software sales engineer. So the company I work for produces enterprise software where we help solve problems, process inefficiencies through our software. And I'm the individual who comes in and presents to the customers and prospects, trying to help them envision what their business could be like if they were to use our software. Outside of that, I'm a mortgage note problem solver. So I like being the bank. I love the fact that you can be the bank, you can control kind of the lending aspect. You don't have to worry about any type of maintenance, really. It's, hey, are you going to pay your mortgage or not? And if you don't, I'll take back the property. So not that I would do that per se, but I do like that component of it. And outside of that, I love personal development. I love reading about it. I love chatting about it. It's kind of more of like a passion project type of thing. You can find me reading about mortgages, investing, but also have in rotation personal development stuff. All right. So that is us. That is the tech guys who invest. That's who we are. And we're going to talk all about cash flow. But first, let's define what cash flow is and the way we like to think about it. And of course, there's technical definitions with regards to business and things of that nature. But at the end of the day, it's just the flow of money from one party to another. That could be between businesses, that could be between business to consumer. It's just the flow of that money. And positive cash flow is income or profits, and negative cash flow is expenses or losses, liabilities, if you think about it in that way. So it's really simple when we talk about cash flow. That's what we're dealing with today. So another way to look at it is if you have a 9 to 5, you have cash flow, right? Your 9 to 5 is paying you. They are transferring money to you. And of course, if you're here, you're looking for ways to either supplement that if you absolutely love your job, or you're looking to kind of give yourself that freedom. And as employees, which all of us are, we're trading our time for this cash flow. That's the agreement that we have with our employers. But the better way, or a better way to create cash flow, is by buying assets. Now imagine that these assets are the ones that are giving you that money, that income. That way you don't have to work if you don't want to.
So let's talk about what an asset is. An asset is commonly defined as something of value, right? Robert Kiyosaki defines an asset as anything that puts money in your pocket. I love that simple definition by him. And he defines a liability as anything that takes money out of your pocket. Now, the big mistake that poor and middle class people make, according to Kiyosaki, is spending their lives buying liabilities instead of assets. Think about all your friends who are driving BMWs and Mercedes around, but they don't have cash flowing investments, right? That's kind of out of balance. Now, most people think investing in assets means buying stocks or bonds or mutual funds, savings accounts, or even a primary residence. So, when considering your primary residence as an asset, I refer to Kiyosaki's definition. Does it put money in your pocket or take money out? And be sure to account for maintenance expenses when determining this, which most people don't. So I don't want to go too far down that track. But regarding stocks and mutual funds, if they are profitable, they tend to appreciate over time. and not really pay a stream of cash each month, right? They kind of appreciate or accumulate. And appreciation is not cash flow. Accumulation of piles of cash are not cash flow. Both of these require you to wait a long period of time for enough money to accumulate so you can begin siphoning off money to pay for expenses. Cash flow, unlike these, is stable, it's predictable, and best of all, it pays you now. But why is that beneficial? Kevin's going to explain that right now.
Don't you want to get paid now? All right, that's our presentation, right? You want to get paid now and you want the benefits of cash flow. One of them is going to be that it can pay for your living expenses. If you took a list or a budget, if you will, of all the bills that you have, all the expenses, the liabilities that you have, you could replace that with an asset that is going to pay for that. Let's say your internet bill is $60. You could buy an asset that's producing $60 a month. Then your internet is effectively paid for. Your mortgage, if you can generate enough money to pay for that mortgage, that's a living expense that's covered. At depreciation, you can't really do that, right? You have this large amount of money that's just going to get eaten away as you continue to live. That's not really freedom, in my opinion, if all you're doing is worrying about how much you're going to be spending. It, cash flow can offer you that freedom of time where you can do whatever you want. You know that the money's going to be coming in. It's paying for this trip. It's paying for you to go out to eat. It's budgeted. You have that option and you can get paid with cash flow wherever you are, right? You could be in Timbuktu, you could be in the South Pole, and you would still collect that cash flow. And as Adam mentioned earlier, it's more predictable. With multifamily, for example, if you have 100 units and you've underwritten it for a 85% occupancy, you know that there's a good possibility that you'll get 85% of that cash flow regularly. And then mortgage notes, if you have a borrower that's paying and you have a note for the next 20 years, there's a likelihood that they would continue to pay that 20 years of principal and interest every month. So we're going to talk about first with cash flow with mortgages, but I want to define what a note and a mortgage is. So the note investing space or note industry, if you will, is really common. If you've ever owed money in any way, shape, or form, whether it's a student loan, a credit card loan, a car payment, you've been in the note business. The only difference is you're the borrower in that case. And I'm sure you remember signing something. I vaguely remember signing something for my student loans. For a credit card, you have to sign something, right? That same thing holds true. It's a contract between you and the lender, you and the party that's lending you money. Or in this case, speaking more broadly, it's between a borrower and the lender. And within that note, there are going to be terms, right? Taking it back to a credit card, you have the interest rate that it tells you. It tells you what the payment will be, the penalty will be if you do late payment. If you log in online, it'll tell you this is the minimum you can pay to make sure that you can cover this or whatever it may be. So a note will have all of those terms. The difference between a note and a mortgage and credit card is the credit card is unsecured debt. So if you were to default on your credit card, you stop paying, it's not like the credit card company is going to come take your house, right? They, to my knowledge, they can't. But with a mortgage, what the mortgage does is it secures the lender's position. So the mortgage ties that promise to pay that the borrower has with the lender to a property. So the lender is protected by that asset. If the borrower ever defaults, that lender can take it back and kind of be made whole. So when we're talking about notes, basically we're talking about notes and mortgages when we say notes colloquially. And when you're talking about notes, they can either be performing, where the borrower is paying monthly, that principal and interest. So if you think about the mortgages you have, 30 years is kind of the most common one, right? So 30 months, or excuse me, 30 years months is what, 360 months. Assuming this person is going to continue to pay for that amount of time, you have 360 months of monthly payments. But there are non-performing notes, and investors buy that. But you're not generating cash flow right away with a non-performing note, so we won't talk about that because it's a little bit more nuanced. But you can get either into performing or non-performing notes. So as I mentioned earlier, the cash flow when you buy a performing note, even one that's already originated. Let's say I have a note, currently I have a note that's a 10-year note. I could sell this note to one of you for the cash flow if you wanted it, and I can recoup my capital. And you would get paid that next month, the cash flow that I was getting paid. And if you want to take one note and turn it into multiple streams of income, there are a few ways that you can do that. You can sell a partial note. And I won't go into too much detail, but a partial note basically is instead of getting 36 payments or waiting for 360 payments, 360 months to get your money back, you could sell the first 60 months for a chunk of that discount, basically. So you get some of your money back, you give up that cash flow, but you can buy another note. I think a lot of people forget that notes are assets and you can borrow against that. I'm not saying that Wells Fargo or Citibank will say, hey, you will loan against your mortgage that you own in your investor portfolio, but there's trillions of dollars in IRA money where you can find an investor where you say, hey, I have this note that I borrow against, 50% loan to value, and you can go buy another note. That way, instead of a partial, you're not giving up that cash flow. You're just using it as an asset to go buy another note. And if you can create a spread with that investor, there are investors out there that are happy with 6% interest. Well, what happens if you find a note that's paying 8% interest? You're thinking that's a 2% spread, but you have no money down, no money into the deal. So that's an infinite return. So with notes, there's a lot of ways that you can create cash flow. As long as you're buying those performing notes, you'll get paid right away.
All right. Thanks, Kevin, for teaching us a little bit about cash flowing with notes. Now I'm going to talk a little bit about cash flowing with multifamily. So I'll start by explaining that large multifamily, which I'm talking about commercial multifamily, which is 5 units and above, uh, the way that typically works is there's a sponsor who finds an apartment property for sale. And a sponsor's like a team who does this. Typically, they're professional investors who do this for a living. For example, a 90-unit property that rents to working class residents, right? The sponsor will go and they'll analyze that deal. And if it's a profitable deal, they will buy it. And then that basically requires an equity raise. So it's not too different from buying a house in the fact that the bank will lend up to a percentage of the value of the property. And then the rest, think your down payment if you're buying a house, that needs to be raised by the sponsor. So that's where passive investors come in. Passive investors are people who are looking to contribute capital, but not do all of the work on an investment. And it is a ton of work. As someone who's doing that actively, I can tell you it requires a team of experienced operators. It is a lot of work. Passive investors, though, contribute capital in exchange for a piece of the deal. And because it's truly investing in real estate, investors get all of the benefits of they get cash flow, they get tax benefits, equity appreciation, debt paydown. Now, essentially, passive investors become a limited partner or an LP in the company that's buying the property. So they're literally owners of the real estate. In that example I gave, they would literally own a piece of the 90-unit property as a limited partner in that company. And that's why they get all the benefits that I mentioned, because they actually own the real estate. And this is really one of the fastest ways to grow wealth. It's one of the reasons I like it so much. Since most of these deals are structured so investors can exit the deal in 5 to 7 years, investors can then redeploy their capital plus the additional returns they've made into another deal. And you can really get the snowball effect going. Now, for cash flow, which is what we're here talking about tonight, the dividends that you get from a deal like this, it's most common that they're quarterly. Now, monthly can happen, but they're less common. It does exist though. Dreamstone Investments, the company that I'm working with, has an investment right now that pays monthly dividends. In fact, I get my payment next week. It's one of the best feelings you get is seeing that payment show up. Um, but one of the many nice things about passively investing in syndications is that you invest your money and then you collect the cash flow during the life of your investment. You receive tax benefits each year. And at the end of the deal, you get a payout of the equity distribution. So it's just paying you many different ways. You receive communications from the sponsor regularly. At Dreamstone, I'm responsible for that, and we send them monthly. And that keeps you informed of the business plan and performance. And more sophisticated sponsors like us provide an investor portal so you can see your current metrics and performance of your investment at any time. And investing in this way, it really is a passive way to invest. And it beats the pants off investing in mutual funds with hidden fees, right? So, also another thing to mention in a lot of these investments is that that capital might get returned to you before the deal ends. So, in a lot of our deals, we have it built into the business plan where the investor capital gets returned after a few years, maybe 3 years, for example, right? But then you stay in the deal and continue getting the cash flow. Even though you got your initial investment back, you go redeploy that somewhere else. Maybe you buy a note with Kevin. Maybe you invest in a duplex, or maybe you invest in another one of these syndications and just have that start working for you while you're still collecting cash flow for the next couple of years until the team exits that deal. And then you share in the equity appreciation that they got during that time. So it's just an amazing way to invest.
All
All
right. So
right.
we wanted
Sorry,
to talk
Kevin.
about no problem. We want to talk about these actions for success. And as you can see, the first one is to get educated. And you may have questions. And of course, we want to address those. We'll save those towards the end. We're almost done with this presentation. So go ahead, Adam.
All right. So, how does one get started? Right. You might think our advice would be to go out and invest immediately. Maybe invest with one of us right away, but it isn't. That's not our advice. Our advice is to get educated, which is why it's fantastic to see you all here tonight, because that's exactly what you're doing. It's very important to clarify your goals, understand very clearly what your goals are, and then identify an investment type that aligns to those goals. As you just heard tonight, there are two very different investment types, right? And they align to different goals you may have. And there are umpteen other ones out there. We just covered the ones that Kevin and I specialize in. But what you want to do is choose an investment type that aligns to your goals. And then you really educate yourself on that investment type. Once you've identified it, dive in and really learn a lot about it. And it's not because you're going to go be an active investor per se, unless that aligns to your goals, right? If that's what you want to do, go for it. But if you want to be a passive investor, you want to understand exactly what you're investing in before you actually invest. Syndicators like us will send you an offering memorandum and an investment packet that has all the details that an educated investor can use to make a good decision about whether this is something they want to invest in. The deals Kevin does, same thing. Like, he'll share the details with you, and then you can make a judgment on whether you'd want to make that investment. You need to be educated and understand what you're looking at in order to make those decisions.
And speaking of education, the resources are out there and investors are always looking to market. So that means that whatever niche you're thinking of, as specific as it may be, I can promise you there's somebody out there that's doing it. So you can learn from them, learn from somebody that's already done it. There's podcasts, there's YouTube channels, there's books, there's audiobooks if you don't like reading. There are just so many ways that you can get educated. You can also reach out to investors, right? Um, sorry about that. So, and we think about cash flow, think about how you can create that income that we were just talking about, how you can produce cash flow for a variety of ways, and what that cash flow can do for you. It's a different way of thinking, right? If we're traditionally thinking about investing in like a 401k or buying stocks, bonds, and mutual funds, yeah, they may pay dividends, but not to the same extent that you can get cash flow monthly like you would with a multifamily opportunity or with mortgage notes. And one of my favorite actions for success is ask why, right? Investors will talk about their deals where they were successful, but they'll also talk about deals where they failed. You can ask them, hey, just out of curiosity, I heard you on this podcast, or I saw your post on Bigger Pockets or on Facebook. I want to learn kind of why you did what you did. And I'm willing to bet they're most likely going to be willing to explain that to you. I know I would be, and I'm sure Adam would be too. Knowing that reason why, it can kind of breaks it down more technically. You start to see the details that aren't really posted on social media, or you can dive deeper in that with the investor.
Absolutely. And last is probably our favorite tip, maybe other than get educated, which is take action. So once you have done the above steps and you feel like you're ready to go, it's really important to take action. Now, what a lot of people do is they get educated and then they don't take action. And a lot of times it's fear holding them back, quite honestly. They've got some mental barriers they need to break through because it, it's really easy just to assign a little piece of your paycheck and that, behind the scenes, sort of almost out of sight, out of mind, goes into some account, like, and it's just, accumulating and buying these mutual funds, right? But then to actually take a big chunk of money that you've got and invest that feels scary the first time, even the second time, right? But don't let fear hold you back. Again, if you've educated yourself and the numbers don't lie, and to you, those numbers mean that it's a good deal and you're ready, do it. Take action. Don't let fear stop you or hold you back.
And if you need another set of eyes, if you're thinking of, hey, I might do this note deal, I'd love to get your opinion on it, reach out to me. If you're looking at this, maybe investing in a syndication or looking at a multifamily deal, reach out to Adam. We're here as resources. And that might be enough action. Booking a time on our calendar, listening to a podcast episode. Action doesn't have to be this massive grand slam of a swing at bat, right? Four singles is a home run. So as long as you're taking those small swings to get on base, if you will, then that's action, and enough of those will lead to massive success. So when we talk about
All
what
right.
we covered what cash flow is. We defined it, and then we also talked about cash flow with mortgages and multifamily. And then we also talked about the actions for success, things that you can do today. As soon as we get off of this webinar, there are things that you can do, whether that's go read, whether that's reach out to us, whatever you can think of, that's available for you.
All right, guys. So if you have more questions about what investing, or if there are ways we can help you, if you want to network with other people, reach out to us, email us, techguyswhoinvest@gmail.com. Also, we'd love it if you checked out our podcast. A lot of people get value from listening to it. We've had a ton of good guests on. I know tonight, a couple times, we've sort of mentioned investing through a 401k. And what we mean there is self directed 401ks, IRAs, solo 401ks, QRPs, and things like that. Most people don't really know what that is. We've had a few really great guests on who explain all that stuff, and just a lot of interesting, neat topics on the show. So we encourage you to go check out the podcast if you haven't listened to that, and let us know what you think.
And if you hear a show, you listen to a show and you think, "Oh, I like this guest," chances are that guest has said, "Hey, you can reach out to me here." So you can reach out to them with the specific questions you may have. And generally speaking, they love that because it shows that you care about what they're offering as far as the knowledge they're providing, the value they're providing. It shows you're doing your research. It shows you're taking action. And I can promise you that from my experience, at least, when somebody is taking action to help themselves, I am more willing to help them versus somebody just asking for a handout. And you're thinking to yourself, I don't have time for this. But if you see somebody making the effort, there's more of an incentive, at least in my opinion, to want to be able to help them succeed. So that's who we are, the tech guys who invest. If you want to learn more about us, you can go to tgwipodcast.com/about. Our bio is there, what we like to talk about, what we enjoy. And we have bonus content for you. We're talking about a lot about, investor identity and how it's so important to know what you need to focus on because we all have some types of constraints. We all have weaknesses and strengths as well, right? What I'm strong at might not be what you're strong at. You may have this knack for analyzing deals that you're just way better than I am, or whatever it may be. But we created a canvas for you to kind of help push you in the right direction. It's completely free. We really would love for you to check it out. Um, this was created because Adam and I look back at things that were difficult for us. And I can tell you, I jumped around a lot when I first started listening to Bigger Pockets, for example. I first thought, oh, I wanted a house hack. And then it said, oh, Airbnbs. And then I learned about mobile homes. And I was like, oh, wow, I can do all of this. Eventually I settled on notes because it fit for me, it fit my personality and what I wanted to do. It aligned with the goals that I had, and that's how I kind of just said, all right, I'm going to laser focus on this. So check it out. We also would love feedback. So canvas.tgwipodcast.com, and you can get it for free. So now we would love to open up the floor for any questions you may have about the presentation, the podcast, whatever. If there are no questions, that's great too.
Hey guys, a quick question. I guess Adam first, you, and then I'll ask a question to Kevin. How did you get interested in syndication, or how did you get started? And did you have a mentor? I guess the question is for both of you. How did you find the mentor, and the process that you took to identify? I mean, Kevin already said, he jumped around. I think that's my situation right now. Like I mentioned to you at the beginning, I'm kind of looking at wholesaling, but I'm having a little bit of a challenge with
Yeah.
that, or a big challenge with it. Being quite frank. So, how did you all get started?
So I very much like Kevin. I also was just I was overwhelmed by all of the options, and I'm the type of person who learns by doing. And I knew I needed to just do something. Like I needed to just start and learn from it and iterate on that, right? So that's kind of what I ended up doing. But it took a while. Like I feel like I spun my wheels to try and get started. I I kind of started with some of the same thoughts you have, Fred, about, well, maybe, maybe I'll start wholesaling, and then maybe I'll flip something, and then I'll get a rental house. And then what I ended up doing is educating myself and trying to find some mentors, as you suggested, which don't have to be a one-on-one mentor who you specifically, you can use people as mentors, like the host of a podcast who you really follow, or a personality, right? If you can use those people as your mentor until you find someone who could, maybe mentor you. And all of the old timers and people with experience that I listened to were like, you know, wholesaling, flipping, that stuff, it's not really investing. I mean, it's great if you want to do it, but it's really like a job, right? Like if you stop doing that activity, the money will stop coming in. And what we were talking about tonight with cash flow is it, you won't get that from wholesaling, right? So they were like, just go straight for the rental properties, right? You want to generate cash flow, and I'm like, okay. So, and they're like, also find a way to do it. And looking back on it, it was super advice, because it would have been just as much work to try to like take these little steps to get to a place where I could buy a rental and then buy a duplex and then eventually work my way up to apartments. If I just went for apartments to begin with, it would have been faster. Not knowing that, fortunately, I did skip the other steps and I just bought a rental house, and that was good enough for me to be like, oh wow, this is real. I could totally see how you can build wealth and freedom this way. And so then I bought a duplex, and as I was doing the mental math about how much of this it would take for me to build up enough cash flow to have total freedom, I was like, man, I'm going to need a lot of houses and duplexes, right? um, and then started learning about apartment investing. Had always thought that was out of my reach. That's for rich people, which I'm not, and I had a lot of mental barriers. So I did get a coach, which accelerates everything. I know it's expensive, but a coach really saves you years. And so I got one, helped me break through a lot of mental barriers. And the more educated, the more I realize I can do this. It's just a matter of surrounding myself with the right team. And so I decided to do it. And that actually is what it's all about. I just committed to it. I'm like, I'm going to do this. And then, I did. So that's kind of how I got there. There's a lot in what I just said, and also, um, active investing isn't for everyone. I'm doing that because it aligns to my goals, and I feel like I need to do that to get where I need to be. But if my situation were different, uh, what I'd most like to do, and what I'll probably graduate to one day, is passively investing in these same type of syndications rather than actively investing in them. It's a lot of work, and I don't want to bust my ass forever.
Yeah, that I don't really know how to kind of say anything different than Adam. Where it came to me when I was thinking about what I wanted to focus on, it was almost like an aha moment where I heard a Bigger Pockets podcast about this note investor who was talking about how if you want to invest, you don't have to buy a rental, you don't have to invest in apartments, you don't have to do Airbnb. You could just be the bank. You can own debt as and be an investor. And it blew my mind. So wait, I don't quite understand it. And he was just talking about how you kind of control everything but own nothing. As the bank, you don't really own the property, right? You own the debt to the property and the borrower's promise to pay. But even large multifamily, right? Somebody's financing that, and there's somebody that owns that financing. And what I loved about it, as far as from a residential perspective, is there's a social component. You can work with the borrower. COVID-19 has highlighted just how many Americans are living paycheck to paycheck, right? And it's just an unfortunate situation for those who have become unemployed due to COVID-19. And it sucks. And as the lender, you can be that individual to say, look, I can work with you. What can you afford to pay at this point in time? As far as like, you know what, I can cut your payment in half, whatever it may be. You have that ability, that social component to help somebody. And let's face it, without COVID, there were people that were one medical emergency away from going bankrupt or divorce or job loss. Those things are going to continue moving forward. And as the lender, you can come in and help solve those problems. Whereas the bigger banks, Wells Fargo's or whatever, Citibanks, they don't care. It's not the business that they're in. They want to kind of get rid of that loan and originate another one. That's how they make most of their money. They're not sitting there trying to say, hey, John Smith, I want to help you out. And as a lender, I love that aspect that I can come in there and say, how can we help you succeed? We want to help you succeed. And at that same time, working with the borrower is the most profitable way to be a note investor. So that's such a huge incentive for me to want to work with the borrowers. And then I just committed, like Adam said, because even when you're in it, you'll hear somebody that's doing something that piques your interest. And as you learn more, things start to seem more realistic, right? You hear, oh, this person's doing short-term rentals. Man, I could totally do that now that I know what I know now about X. Because you're going to learn a lot. If you say, oh, I'm just going to learn about multifamily, you're going to learn about financing multifamilies. You're going to learn about single family homes as well, and just kind of the logistics around that. So as you learn more, there's going to be a lot more things that are going to seem more viable, but you have to stay committed to the thing that you're going after.
And that's just
Not sure if that
increasing your
exactly answers
financial
your question.
intelligence. You know,
Mm-hmm.
to your point there, that's just increasing your financial intelligence. As it grows, you start to realize other possibilities. You start to see more opportunities. Yeah, it's pretty amazing.
And while we recommend mentors, like Adam and I met actually in a mastermind group that we decided to pay for, that's not the case for everybody, right? Some people don't necessarily need that. For me, I knew I needed that. And of course, I'm grateful because otherwise, Tech Guys Who Invest wouldn't be here. But if you can do it on your own, you can treat the authors of books as your mentors, the hosts of podcasts as your mentors. Those people are available for you to ask questions. Send them an email. I mean, the worst that happens is they just ignore you. But the best is you get your questions answered.
If you guys share some tips how you found your mentor, because I'm interested in buying and hold rentals, and I read some books and they have analysis and but then when I apply to the houses here in Tampa, Florida, I don't get the good deals. So maybe it's just a local thing. So I want to find mentors, and I don't know how to.
Yeah, it's
Yeah,
a good question. Adam,
yeah,
you want to go ahead first?
sure. I mean, so I'm going to talk about mentor since you talked about that specifically, Ty, rather than coach, because what Kevin and I both did is we paid for a coaching program, and a mentor is different than a coach. A mentor is more somebody who just helps guide you and is there to help grow you, but it's a lot less, I guess, a lot less intensely focused right? Um, and a lot of times a mentor is not necessarily a paid thing, although sometimes it is. But like Kevin said earlier, you can use authors of books or podcast hosts, or some kind of a thought leader in an industry as a mentor, just by following them and reading their content. And then if you reach out to them, you could try to establish some kind of relationship. Now, a lot of those people are super busy, and they're not always able to just take people on for things like that. Some of them do allow that for a fee, and to find them, I think it's a matter of really lasering in on the actual type and the actual focus of your investor identity. And then also, I think an important component, at least for me, it is their personality type, and does it align well with you? I mean, Larry Harbaugh just is the first name that pops into my head when you're talking about single family homes here in the area, right? But his personality type is not for everybody. So you may want to think about personality type, how it matches up to you, as well as the technical skills of the craft.
Yeah, I that's what the point I was going to make, but then Adam eventually covered it. Finding out somebody you mesh with, because you're going to kind of be struggling with them. And what I mean by that is you're going to them with these struggles, with these problems. You don't need additional stress of you not getting along with them or you not being happy with how you're being coached, kind of thing. So you almost think of it as like you're dating, where you need to find the right type of a partner, the right type of chemistry, where you can get motivated. They can try to, the way they describe technical terms, the way they tell you how to find things and create their processes that mesh with you. That is a hugely important thing, because if that is not going to go well, then you're just setting yourself up for failure. And I would also spend the time reaching out to these people that you think might be your mentors and asking them, do you do mentorships? Have you mentored? Something along those lines. Are you willing to mentor? Because again, if they don't have the time, they probably just say no or what have you. Or one way you can do it is to kind of get their attention is, hey, you said this on a specific podcast episode. These are my questions, and I need, and then using that as a way to break the ice with them. Because like I said, you're showing that, hey, you're following them already, and it's very specific questions, so they can have a specific answer, as opposed to something very broad, like how do I invest for cash flow? Like, why are you wasting my time? But you said, hey, you said X, Y, and Z on this podcast episode, and these are the questions I have for it. Can you help me understand it? Now they're going to be more specific with their answer, and that could be a great way to get your foot in the door with them. All right. Any other questions?
Yeah, I had another quick question.
Sure.
I'm kind of like you guys, that I have to see it. I have to do it in order for it to kind of register in my head. And that's usually what I do anyway in anything that I'm trying to learn. I mean, if you show me one time or a couple of times, and then I'll get my rhythm, and then I'm running with it. Um, as far as because you both mentioned mentoring and coaching is different. Because I also paid for a coaching program for doing the wholesaling and all the stuff that I'm interested in doing. But I'm not sure if it's a mental block on my part, or if it's because I've been researching some other, I guess, quote unquote gurus online, and everybody's touting their own, hey, if you buy into our program, you can get this XYZ. How do you differentiate between, I guess, the fluff of, hey, this is what we're selling to you, buy into our program, but then you realize it's not too much support in there, other than the fact that you just dished out a big chunk of cash
Right.
for the quote unquote coaching, as opposed to the ones that are like really on point and really effective.
Referrals.
Yeah, I was just going to say that referrals are a big way to go. I would also Google it, right? I Google the people that you're potentially going to find. You'll have to dig a bit more, because they generally speaking, these gurus are going to be great at marketing. So they may kind of find a way to get testimonials to be the first search there. But I can promise you, if somebody's been scammed, they are more than likely going to talk about how upset they are and want to warn other people. So you have that to your advantage. Use forums. I think forums are a lot better because it's supposed to serve as a place of public discourse. So somebody that's been scorned by a guru, for example, they'll most likely talk about it and reach out to them directly, get there. If you don't feel like posting it in the forum, ask them, hey, what was your experience personally?
Fred, follow up on those referrals. So this is a mistake many novice landlords make with tenants. They'll ask them for references and then they don't call the references, but you should. So get references, follow up on them, call them, and kind of have a list of things that you want to ask them about and ask them your questions. It's important to follow up and actually call those references, find out what they liked about them. That's what I did before I got my coach.
Yeah, my coach I met through a referral. Same thing. So that's exactly how it works. And there's so much power in the referral. Of course, it has to be somebody you trust, right? You're not just going to ask some stranger that you have no kind of bearing of what they do or whether or not you connect with their mindset, some type of an important referral like that. But asking around is going to be huge.
If you go to like some of the local Tampa RIA meetings or RIA meetings wherever you're located, and also try and join some of the groups for the particular focus that you're concerned with, you can ask in those groups and ask those people, and word gets around really fast about who is legit and who's not.
Yeah, I agree. All right. Any other questions? If not, thank you guys so much for your time. We really appreciated this, and hopefully we'll see you next month as well.